All right, welcome back. You're watching The Money Show with me, Kavita Thapliyal. So let's now shift focus to AMCs and their investing styles. Remember, every AMC has its own set of investing philosophies and strategies which determine the performance of a fund. So how do India's top 5 AMCs invest? What is their investing mantra? All of this we will get you, but then let's also understand the basic investment styles, on the basis of which, whether it is AMCs or huge investment names, what is the kind of strategy or investment styles do they follow? So usually what we all know about is value. That is one very important or a very famous style of investing. There is growth-oriented investing, sector-specific investing style, where you will see a lot of investors focusing on specific sectors. You'll be having index investing style as well. But then when we talk about an AMC, when we look at from a AMC perspective, how exactly an AMC changes their investment styles or their investing style, how can they incorporate all these investing styles in one particular fund maybe, or in their different funds? And also, do these investing styles vary from time to time as the market move? We have to understand all of these, because based on these understandings, you can have a portfolio or maybe a fund from that particular AMC that matches with your investment horizon, which matches with your risk profile, and also the kind of goals that you have lined up for your investment portfolio. So understanding investment styles are very important, not only from an AMC perspective, but also understanding what kind of an investor are you. A lot of times what we do is we just accumulate a lot of stocks in our portfolio. We accumulate a lot of funds in our portfolio without having any idea of being well diversified, or a lot of times we realize that we are over diversified across market caps. So understanding investment styles helps you as an investor to have a matured approach to your portfolio. And also a lot of times people who are traders also tend to become investors, if at all they understand these kind of investing styles. So we will get you we'll get you a run up on all these things, and also tell you what all of these investing styles actually mean. So if you look at the growth style, so the growth style has companies, they invest in companies with high earnings growth, with very high potential. And before that, so we will get you all this with Feroze Azeez, but then before that, Rahul Chadda, investment officer, Mira Asset Global Investments, believes that the next few months will be very challenging for the markets. So let's listen in more of these views on the markets, and also select on sectors.
I think next 3-4 months would be challenging, and I think we saw that in IT services result, where there is a sharp demand slowdown which has happened in recent months, and I think it continues. US economy is slowing further, and likely that probably around fourth quarter of this year or first quarter of next year goes into a mild shallow recession. So I think that is where the slowdown is going to come in the Indian economy also. That's largely going to come from weakness in exports, and that impacts the job creation around it.
What should be the best investment strategy? There is a visible fear in IT, but there is a visible growth in banking. There is a visible slowdown in rural India, but there is a visible uptick in urban India. What is the best way to stay put in this market?
I think the best way to stay put is take a medium-term view. Look, near-term is going to be challenging, but that is where you get entry points. Most of us been saying that for a while, but look, in markets you don't make money every day, every month. You make money in spurts, and this is what we've got to understand. But if you're not positioned for it, you miss those spurts. And I think somewhere those moments are going to come.
All right, that's the view from Mira Asset India. But then we have Feroze Azeez, Deputy CEO, Anand Rathi Private Wealth, with us. Feroze, good evening. Welcome to the show. We are going to focus on different investing styles that AMCs follow. But before that, can you just lay down the kind of investing styles that are normally followed, or are the existing investment styles?
Yes, Kavita, like you rightly pointed out, several asset management companies in their business, about 40 odd of them. And if you look at the styles each of them will follow, are going to be diverse. So let me lay down a few of them which are quite prominent. This is not an it's not an exhaustive list of styles, but still some prominent ones which have meaningful assets. When you look at one kind of style which is valuation based, there are two categories in that. One is a value fund or a value style or a growth style. A value style is to buy businesses which are cheaper today, may not be the darling of the market currently, but they are inexpensive, in the hope the fund manager buys those that in the future, when people realize that this is coming at a reasonably attractive price, people will buy it, and that's when the fund manager will make money. That's the value style of investing, buying cheaper businesses, which may not be the ones which have done too well in the past. That's value style. Then on the contrary, the diametrically opposite end, which is the growth style, which as the name suggests, is buying stocks which are growing very well, may be expensive today, may not sometimes even justify the value, but they're growing so beautifully that the earnings will actually catch up with the valuation. That's the second thought process. That's the next school of thought. So value fund and a growth fund are funds which encompass these two distinctly different, diametrically opposite styles. That's two of them. Then if you look at the third style, which is again prominent, which is sector-based investing. So sector funds, which invest in specific sectors like a pharma fund, a banking fund, an infrastructure fund, which is a little broader sector. So these are sector funds which buy stocks in similar businesses. So that's the third style. The fourth style of investing is quite popular globally, which is the index investing, where the fund manager tries to not use too much of his or her judgment, but tries to replicate an index. So efficiency in implementation and execution becomes the mandate of the fund manager rather than trying to beat the index. So four distinctly different styles: value and growth, one kind; sector and index, the prominent ones which have gained momentum in the recent past. Could be four, which I thought I should touch upon.
So Feroze, talking about these investing styles and the kind of strategy these AMCs adopt as to reflect these styles on their funds, how does it happen? Because at one point in time, you can have different types of styles depending on the kind of fund you're managing or you have to offer to your investors. And these investing styles also change as per the market momentum. So we just cannot say that a particular fund will have an investing style all throughout its journey.
So with Kavita, the answer is yes and a no. Some funds in their own mandate are so clearly defined that they follow the same style till eternity. Some are not. Like for example, a sector fund is going to be a sector fund today. It's going to be a sector fund 10 years from now, because the mandate of the fund is so restrictive that they're going to invest in a banking sector fund, for example. If the name itself compels the fund manager to stick to the style, then that's going to be till eternity, unless the objectives and the key information memorandum goes through a change. That's point one. There are some funds which follow a style out of choice. Like, for example, a large cap fund can follow a value philosophy or can follow a growth philosophy. They're not actually binded by the principle of the fund or the objective of the fund. That is their own style. For example, like Prashant Jain, who was a very prominent CIO of HDFC for decades, had a blend of value philosophy in his style. So if you look at HDFC FlexiCap, HDFC Equity, most of HDFC funds had a rub-off of the CIO that he likes to buy cheap businesses. He is very price sensitive. So that was out of choice. So HDFC FlexiCap could choose a value or a growth, because it's not mandated by SEBI that you will choose any of these. So if that choice is of the fund manager, then the styles as per the contemporary market situation could undergo a change. You might buy a fund which was value when you entered. When you exit it, the fund manager changed it to a growth principle. So that's how this sometimes is fluid, sometimes it's hard-coded.
Can an investor at an individual level have any of these investment styles? Do you think that's good for them, or investors should clearly just have a very financial goal-based strategy for their portfolio?
See, Kavita, in my opinion, managing money is a two-dimensional thing. One is internal, the other is external. It is not either or. So if you have a goal-based investing, that's more internal, trying to make sure that you have your objectives written down, what's the kind of savings you will have to have, what the kind of asset allocation you will have to have. All that is derived out of your current status, which is what the personal aspect of personal finance comes into picture. The second part is the finance of personal finance. Finance is a mathematical subject. So in certain periods of markets, a certain style does better. For example, in 2021, beginning of 2021, we have had a clear vision at Anand Rathi Wealth that value will do very well. And that actually transpired to be that way. So HDFC FlexiCap came into our recommendation and it generated an alpha of almost about 20% in the last 2 years over Nifty. But the previous 5 years, value was a principle, didn't work at all. So to answer your pointed question, both are critical. One is an internal variable, which is the personal side of personal finance. And the second is the finance side of personal finance, requires having a two-dimensional strategy, not just unilateral.
All right, I think that will be all as far as this topic is concerned of investing styles that AMCs adopt. But we have a lot of queries lined up for you, Feroze, and we have our first caller, Mr. Avadhoot Kulkarni from Kolhapur, Maharashtra, who wants to ask his question. Mr. Kulkarni, hi, good evening. How are you doing, sir?
I am fine, madam. How are you?
I'm doing good, thank you. You have PGI Mid Cap, Canara Robeco Large Cap, Nippon Small Cap in your portfolio, right? And you want to hold these funds for 20 years.
Yes.
And what is the corpus that you're looking at for retirement?
Near about 50 lakhs.
Will that be enough for you?
Yeah, I hope so. Yes.
Okay, so I think we'll get the calculation on that also
Yes.
from Feroze. But then, do you want to increase your SIP amount? Will you be able to do that as and when it's possible for you?
Yes. I target to buy 30% per year.
Oh, 30% per year. Okay, that's a good amount. All right. So Feroze.
Yes, I think Kavita, you pointed the question in the right direction in terms of, will that be enough? Will 50 lakhs be enough 20 years from now? To my mind, definitely not. If a person can actually save 10,000 rupees per month today, 50 lakhs for retirement will certainly not be sufficient after 20 years, because the value of 50 lakhs after 20 years, please assume that to be 1/4. So it's like 12 lakhs today. Would Mr. Avadhoot retire with 12 lakhs today? I don't think so. So try and revalidate that number, because every 10 years, the value of money at a 6-7% inflation becomes half. So in 20 years, it becomes 1/4. In 30 years, it becomes 1/8. So that's the basic thumb rule you should look at. So 50 lakhs 20 years from now is just 12.5 lakhs, which is 1/4 of 50 lakhs. Now, if I gave you 12.5 lakhs today, would you retire? I doubt that, right? Your expenses are going to definitely be significantly more than your retirement could actually sustain at a 12.5 lakh corpus. So that's one. Second, I'm very, very thrilled to hear a number of 20 years kind of investing timeframes. 5 years back, you would not have callers who say 20 years as their investing time frame. So I think great, Kavita. I think education at your end has helped people look at long term, truly long term. Now coming to the schemes which you hold, Mr. Avadhoot. So I think two of them deserve to be a part of your portfolio. One thing which can go on the annual for an exit whenever appropriate, you would be the best judge in terms of exit loads and tax implications of the decision. Canara Robeco Blue Chip Equity could be an exit. Instead of that, I can give you a lot of funds which, in our opinion, have a forward-looking, prospectively looking great future. And given the fact that you're able to increase your SIP amounts by 30% every year, you may need a few schemes. So let me read out about 3-4 from the list of 8 which I see. HDFC FlexiCap, ICICI Focused Equity, HDFC Small Cap, SBI Large and Mid Cap, SBI Contra, and Franklin India Blue Chip. These are some of the schemes which you can add to your portfolio as and when the amounts become large enough.
All right, with that, we move on to our next question from Brijesh. It's via email, and he says that he's 48 years old and he's an NRI and planning to retire at around 55 or early. And he has some fixed deposits and another 75 lakhs invested in stocks, and investment advisor has been asking him to sell the funds invested through broker or invest them directly. Now, so he's confused basically in order what kind of an approach he should be taking on, and we don't have his exact exact portfolio details, but then what would you recommend, Feroze?
See, I think, Kavita, this is a larger debate in terms of should I go direct or regular. See, if you're as a client, if you've made your choices of the schemes, and if you think you have the capability of being able to monitor and make changes in the funds which are there a part of your portfolio, then you can go direct. But if you think that somebody can monitor it, make changes timely, because you can be married to equity as an asset class for 10, 15, 20 years, but you don't have to be married to a scheme beyond 2, 3 years, because the scheme's job is to deliver excess returns over the equity returns of Nifty, let's assume, if that's the benchmark. Now, if you look at our model portfolio for the last 9.5 years, have gone through a reasonable number of changes, 38 entries, 36 exits. And that's why 3.2% of alpha over Nifty year on year compounded has been generated. Because quite a few schemes who do well in the past don't do well in the future. And the best and the worst scheme have a difference of 30% every year. So if you believe that you can do it yourself, look at the shows in terms of electronic media. The Money Show can give you a lot of guidance. As long as you're going to be on top of it, go direct, save that 1% cost. If not, I think it's better to have an advisor or a distributor who can monitor and make changes timely.
With that, Feroze, it's time to wrap up. Thank you so much for being on the show and helping our viewers with every aspect of their financial planning. And before I sign off, I'm going to leave you with our WhatsApp number and email ID where you can send us your portfolio-related queries, but also do send us your portfolio details. Thank you so much for watching. Goodbye.